Small businesses are the backbone of the American economy, yet many struggle to find fair and flexible funding. Traditional loans often come with strict repayment schedules and high pressure on cash flow. For entrepreneurs and investors looking for a more balanced approach, profit-sharing investments provide a transparent and ethical alternative. This guide explores how such investments work, how they build trust, and why they can be a powerful method for growth in the small business sector. Profit sharing is a simple but smart idea. Instead of paying fixed returns, profits are divided based on performance. When the business grows, both sides benefit. If the business faces a slow season, the investor's return naturally adjusts. It creates a partnership built on real results rather than financial pressure. This shared approach encourages teamwork, long-term thinking, and accountability from everyone involved. Many small business owners in the USA are turning toward this model because it feels fair. Traditional financing can make them feel trapped in a cycle of constant repayment. Even when revenue drops, profit sharing allows them to breathe, make smarter decisions, and focus on innovation instead of debt. Investors appreciate this model because it connects them directly to the success of the business, not just the paperwork behind it. Consider a simple example. A coffee shop in Austin, Texas, wants to expand by opening a second location. Instead of taking a loan, the owner invites an investor to join under a profit-sharing agreement. The investor provides capital for renovation and equipment each quarter after all expenses are covered. Both parties share profits based on a pre-agreed percentage. This way, success depends entirely on how well the shop performs. The investor becomes a partner in growth rather than a creditor expecting a fixed return. The most important part of profit sharing is clarity. Every agreement must define what counts as profit, when it will be calculated, and how it will be distributed. A lack of clarity can cause confusion or conflict later. Before any investment is made, both sides should review financial expectations together, preferably with professional advice. The more transparent the structure, the smoother the partnership will be. In the United States, small businesses thrive on trust and reputation. Investors want confidence that the business is managed efficiently, and business owners want assurance that investors will stay committed through ups and downs. Profit sharing builds that bridge. It removes the fear of hidden terms and emphasizes open communication. When handled correctly, it creates a business environment where growth feels earned and shared. Profit sharing also strengthens motivation. When both investor and owner have a direct stake in performance, they naturally think more creatively. The owner works to improve sales and manage costs, while the investor may contribute ideas, marketing connections, or experience. This teamwork transforms financial collaboration into real partnership, one that focuses on building something sustainable, not just profitable. Before entering such an arrangement, due diligence is key. Investors should study the market, analyze the business plan, and understand the risks involved. Profit sharing does not guarantee income, and that's what makes it fair. Rewards are tied to actual performance. For the business owner, it's equally important to maintain proper accounting and communication. Both sides must operate with honesty and discipline to make this model work. Long-term, documentation plays a vital role. A written agreement that clearly defines the roles, responsibilities, and share of profits avoids future misunderstandings. It's not about distrust. It's about professionalism. In the USA, most successful partnerships are the ones that put everything in writing from the start. This helps both parties stay aligned and ensures that everyone knows what to expect. Profit-sharing investments can take different forms depending on the business type. Some small enterprises may choose quarterly profit reviews, while others prefer annual settlements. What matters is consistency. Both sides should agree on a schedule and stick to it. This predictability builds confidence and helps in financial planning for both parties. In recent years, more American investors are showing interest in community-based businesses using this approach, from organic farms to local tech startups. The idea of sharing profits based on performance is gaining momentum. It's not just about money, it's about shared values and long-term vision. Profit sharing allows people to support businesses they believe in, while giving entrepreneurs the capital they need without the burden of debt. Investors who choose this route often find it emotionally rewarding as well. They see how their capital creates jobs, supports local communities, and builds real products or services that make a difference. Instead of being distant financiers, they become part of something meaningful. That sense of contribution adds another layer of value beyond profit figures. For small business owners, this model encourages better management habits because profits are shared. They learn to budget carefully, track expenses, and plan ahead. It promotes discipline and transparency, qualities that strengthen the business from within. Over time, these habits turn a small venture into a stable and scalable enterprise. The beauty of profit sharing lies in balance. It balances ambition with realism, risk with reward, and effort with outcome. In a world where many business relationships are built on short-term gain, this model reminds people that shared growth is stronger than individual pursuit. As small businesses continue to evolve in the USA, profit-sharing investments offer a fair path forward, one that combines ethics, transparency, and collaboration. It invites investors and entrepreneurs to build together, earn together, and grow together. It replaces debt pressure with partnership and creates opportunities where everyone wins through genuine effort and trust. Profit-sharing investments continue to gain attention in the USA as more people search for transparent and responsible ways to grow their money. In a business landscape dominated by debt and fixed interest financing, this model offers something refreshingly fair. Success is shared, and challenges are faced together. It encourages partnerships built on mutual respect, clear communication, and accountability. This part of the guide focuses on how investors and entrepreneurs can apply profit sharing effectively, minimize risks, and build partnerships that lead to real growth. The first principle of any strong profit sharing partnership is structure. A well-defined structure outlines who contributes what, how profits are calculated, and when they are distributed. Without this clarity, even good partnerships can collapse. Many small businesses in America begin with enthusiasm, but fail due to poor organization. Profit-sharing arrangements demand discipline, documentation, and ongoing review. It is not enough to trust the concept. Both sides must design a system that is transparent and simple to follow. The next principle is mutual understanding. Investors must understand the business model they are entering. Entrepreneurs must understand the expectations of their investors. When these expectations align, partnerships become strong. For example, an investor may be focused on stable long-term income, while the entrepreneur may aim for aggressive expansion. These differences are natural, but must be discussed before any money is invested. Once the plan is clear, both sides can move forward with confidence. To illustrate, consider a small digital marketing agency in Denver that specializes in helping local businesses go online. The agency has proven results, but needs funds to hire more staff and expand. An investor offers $60,000 under a profit-sharing agreement, with both parties agreeing to share 40% of the quarterly profits. The business grows steadily over the next 2 years, and profits increase as the agency gains new clients. Instead of paying interest or fixed repayments, the investor's share rises naturally with performance. This example shows how profit sharing can create a balanced and motivating relationship. Transparency in record keeping is vital. Every dollar earned and spent should be traceable. Using proper accounting systems and shared reports helps maintain trust. Both sides can review financial statements at regular intervals, monthly, quarterly, or annually, depending on the agreement. This habit not only prevents misunderstandings, but also helps identify new growth opportunities. When partners regularly analyze performance, they can adjust strategies faster and make better financial decisions. Another key to success in profit-sharing investments is fair risk distribution. Both investor and entrepreneur must accept that business has ups and downs. Unlike loans, where the borrower bears all responsibility regardless of results, profit-sharing distributes both success and risk. When times are good, both enjoy rewards. When challenges arise, both share the impact. This shared responsibility builds a sense of unity that strengthens the business relationship. Communication is what keeps this unity alive. In many failed partnerships, the issue is not financial loss, it is silence. Regular meetings, even short ones, can prevent major problems later. Simple updates on sales, expenses, or upcoming challenges can make investors feel involved and valued. Likewise, investors should be supportive rather than demanding, giving entrepreneurs the confidence to lead operations effectively. Respectful communication creates a partnership culture where honesty is rewarded and trust grows naturally. Profit sharing also offers flexibility for small businesses that experience seasonal fluctuations. For instance, a restaurant, a travel agency, or an event planning company may earn more in some months and less in others. With a profit-sharing model, payments adjust according to actual performance, reducing financial pressure during low seasons. This makes the business more stable and less dependent on borrowing. It also helps investors see a clearer picture of the company's true earnings cycle. Scalability is another strong feature of profit sharing. Many investors start with one small business and, after learning the process, expand to multiple ventures. They create a portfolio of partnerships across various sectors: retail, services, online stores, and even manufacturing. Each business may be small individually, but collectively they create a stable source of diversified income. This approach lowers overall risk because performance in one sector can balance slower returns in another. For small business owners, profit-sharing investments bring more than just capital. Investors often bring experience, connections, and strategic insight. They can help refine marketing, introduce new clients, or suggest operational improvements. When investors contribute knowledge, along with funds, the business grows faster and smarter. This blend of financial and intellectual capital is one of the hidden strengths of profit-sharing partnerships. Legal documentation remains a crucial component of this system. Even if partners trust each other, written agreements are non-negotiable. Contracts should clearly define responsibilities, investment amounts, profit ratios, reporting schedules, and procedures for withdrawal or exit. In the USA, legal templates for partnerships or limited liability arrangements are easily available, and consulting a business attorney ensures all terms comply with state laws. A strong legal foundation gives security to both sides and reduces future disputes. When structured correctly, profit sharing can also improve employee motivation. Many small businesses now extend similar arrangements to team members through performance-based bonuses linked to company profits. When employees understand that their efforts directly impact the company's earnings and that they share in the success, productivity rises naturally. This builds a company culture centered on accountability and pride in results. From an investor's perspective, profit sharing demands patience. Unlike fixed income investments, this model rewards consistency and long-term growth. There may be quarters with modest returns, but over time, as the business matures, profits typically rise. The key is to think in terms of years, not months. In the American market, where small businesses constantly evolve, investors who remain patient and supportive often achieve better outcomes. There are no seeking quick gains. For evaluation, investors should regularly assess business performance using measurable financial indicators. Net profit margin, revenue growth, and cash flow analysis help track how well the company is doing. Investors who monitor these indicators can spot patterns and make timely decisions. For example, if profits are declining, both parties can discuss causes and introduce changes, such as revising pricing, improving marketing, or reducing unnecessary expenses. In a broader sense, profit sharing promotes financial inclusion. It allows more people to participate in business growth, even with modest capital. Instead of relying on banks or complex financial systems, individuals can directly invest in local enterprises and share in their progress. This strengthens communities, creates jobs, and supports innovation. It is a way of building wealth that benefits society, not just individuals. The emotional benefit of profit sharing is often underestimated. When an investor sees a small bakery they funded hiring more staff, or a startup they supported launching a new product, the reward goes beyond financial return. It becomes a sense of achievement and purpose. Many investors describe it as watching their investment come to life, a satisfying blend of financial and human success. Ethical standards must always remain central. Profit sharing only works when honesty, fairness, and respect are present. Cutting corners, hiding figures, or manipulating reports can destroy partnerships. On the other hand, consistent integrity builds long-term relationships that extend far beyond one project. When partners trust each other completely, they can explore new ventures with minimal friction. As the USA continues to encourage entrepreneurship, profit sharing offers a model perfectly suited to modern business realities. It aligns the interests of both investors and entrepreneurs, removes the pressure of debt, and supports sustainable growth. For small businesses looking to expand responsibly, and for investors seeking fair participation without exploitation, this model offers a balanced path. In the end, profit-sharing investments are not just financial agreements. They are partnerships built on shared vision and effort. They remind both sides that success means more when earned together. In a fast-changing economy where trust is often missing, this approach reintroduces fairness, transparency, and human connection to business. For anyone looking to grow wealth while supporting genuine entrepreneurship, profit sharing in small businesses stands as one of the most dependable and meaningful paths forward.